Who is the deity of the investment world? If Buffett claims the title, no one else would dare to challenge him. The legends surrounding him, his vast wealth, his ability to grow it like a printing press, and his legendary stock market prowess are the stuff of countless stories. Some are even shrouded in mystery. These stories have driven countless wealth seekers wild with fascination. How did Buffett achieve such godlike status in investing? Why can't others replicate his success? I strongly recommend spending 30 minutes to explore Buffett's life. Warren Buffett, the Oracle of Omaha, and a billionaire, had assets of $128.7 billion as of February 1, 2024, ranking him fourth on the Forbes Global Billionaires list. The annual Buffett Lunch has become a must-see event in the global finance calendar. Buffett's empire is based in Omaha, a small U.S. town with fewer than 500,000 residents. He still lives there with his family, not in Wall Street, New York. The headquarters of Berkshire Hathaway, the insurance and investment company he leads as CEO, is also in Omaha. Its subsidiaries span industries like insurance, transportation, finance, technology, food services, and textiles. Examples include Geico, one of America's largest auto insurers, and Dairy Queen, the famous food brand whose DQ ice cream you might enjoy. Berkshire Hathaway also holds significant stakes in well-known companies, such as 2% of Apple, 28% of Occidental Petroleum, 9.3% of Coca-Cola, 27% of Kraft Heinz, 21% of American Express, 8.95% of Bank of America, and 6.74% of Chevron, among others. In short, it's almost impossible to live a life untouched by companies Buffett owns or invests in. Thus, his influence is felt worldwide, under Buffett's management. Berkshire Hathaway is renowned for providing shareholders with exceptional long-term returns. Just imagine, if you had invested $10,000 with Buffett in 1956, it would be worth about $300 million today, after tax. In an interview, Amazon CEO Bezos asked Buffett why others couldn't achieve success with such a simple investment philosophy. Buffett's reply was straightforward: because no one wants to get rich slowly. Despite this, Buffett, born on August 30, 1930, into a conservative white family. His father Howard, a staunch conservative with local prestige, was not only a firm opponent of Roosevelt's reforms, but also Buffett's career inspiration. A photo of his late father hangs prominently in Buffett's Omaha office. Buffett has often stated in interviews that his father had the greatest influence on him. Though he rarely mentions his mother Layla, the family's financial situation became tight with the arrival of Doris and Warren. Layla, who was controlling and somewhat neurotic, caused young Buffett some emotional trauma, leading him to feel uneasy in her sole company in later life, something his sister Doris also experienced. However, after the family's financial conditions improved, and Bertie was born, she and Layla had a better relationship. This shows that while Buffett grew up without financial worries, he wasn't a typical rich second-generation individual. Years later, when reflecting on his investment journey, Buffett first cited the ovarian lottery. Being born in 1930 into a relatively comfortable American white family, he believed this gave him an advantage few others had. As a child, Buffett was shy, but found his passion in numbers. Once, with a stopwatch, he invented a bathtub game with glass balls, timing their descent to the bottom. He could play this game all day. This interest later helped him make money. In the U.S., even today, selling fruit juice is a common way for kids to earn pocket money. And Buffett was no different. By collecting and analyzing fruit juice bottle caps, He determined which juice was more popular and focused on selling that one, increasing his revenue. This was his first business success. Later, he applied this data processing talent to selling gum and acting as a horse race ticket agent. A painful loss at the racetrack taught him never to put all his money on one horse. At 10, Buffett asked his father Howard to take him to New York, instead of choosing Disney World or the Yankees. He picked the Wall Street Stock Exchange. The agent's tickets, the flashing numbers on screens, and the changing expressions of people fascinated him more than a baseball game. After high school, Buffett started trading stocks. His teenage rebellion was financially flavored. He shorted his disliked teacher's stock and showed the proof to the teacher. After 4 years of college, Buffett hit a major life turning point when he was rejected by Harvard Business School and ended up pursuing a master's at Columbia University under Benjamin Graham, his investment idol and mentor. Buffett had noticed an unremarkable stock, Geico, which differed from traditional insurers by only serving you as civil servants. With stable cash flows, high insurance rates, and lower risk of accidents, Geico had lower claims costs and higher profits. Graham's investment company held a significant stake in Geico. Buffett studied Graham's The Intelligent Investor and deeply agreed with its investment philosophy. Reading became a lifelong habit. In Graham's Columbia class, Buffett knew the material better than his teacher, turning the class into a duo show with Graham. Other students struggled to keep up. Graham's investment philosophy can be summarized in 3 points: value investing, market fluctuation arbitrage, and emphasis on capital safety, with timely profit-taking and loss-cutting. These ideas were unique at the time. Based on Graham's theory, Buffett developed his own investment philosophy: cigar butt investing, mean buying undervalued securities, meeting certain risk control standards, arbitrage during specific events unrelated to market trends, and gaining control through large-scale stock purchases to influence company decisions. In his early career with limited capital, Buffett mainly used the first 2 strategies, especially the cigar butt approach. He explained that, although cigar butts aren't tasty, they're free. The American National Fire Insurance Company, headquartered in Omaha, was founded in 1919. Dishonest insurance agents sold its worthless stock to local farmers at $100 per share. The stock was nearly valueless for a long time. In the 1950s, the Harmson family transformed it into a legitimate company with rising stock value, but the farmers didn't realize their stock had become valuable. In 1956, the company had earnings of about $29 per share, and the Harmson family bought it at $30 per share, a price-earnings ratio of 1. It was a perfect big cigar butt. The Harmson family secretly bought back stock from farmers. By 1956, they owned 70% of the company. When Buffett found this company in Moody's manual, he decided to buy its stock, but found it difficult as only the Harmson family had the shareholder list. So, Buffett sent his partner Don Mohn to buy the stock with cash in rural areas. Buffett initially offered $35 per share, higher than the Harmson family's offer. As farmers became alert, the price rose to $100. After hard work, Buffett acquired 2,000 shares, 10% of the company. To avoid competition with the Harmson family, Buffett didn't register the shares under his name initially, but added a lawyer's note. After collecting enough shares, he visited Harmson's office with the securities and declared he would register them under his name. A year later, Buffett sold the shares at about $125 per share, a 100% yield. In the 1960s, with extensive reading, data analysis skills, and strong execution, Buffett made many cigar butt investments. In 1954, while working for Graham's investment company, Buffett encountered a cocoa bean price surge from 5 to over 50 cents per pound. The Rockwood Company, a Brooklyn chocolate maker, faced a tenfold cost increase. However, its net assets rose due to the cocoa bean inventory price surge. To avoid heavy taxes on selling cocoa beans, Rockwood sought a buyer. Graham Newman Corporation found the price too high and rejected it. Then Rockwood approached investor J. Pritzker, who found a tax avoidance method. According to the 1954 U.S. tax law, inventory clearance from reduced business scope was tax-free. Pritzker bought controlling shares of Rockwood. He dropped the cocoa oil part and moved 13 million pounds of cocoa beans into the cocoa oil business for liquidation, transferring 30 million pounds of cocoa beans into it for tax-free clearance. Instead of exchanging cocoa beans for cash, Pritzker offered to swap them for shares to increase his equity. He offered $36 worth of cocoa beans for $34 shares. Graham found a way to profit by buying Rockwood shares, exchanging them for cocoa beans, and selling the beans for a $2 profit. To lock in profits amid cocoa bean price risks, Graham had Buffett sell futures. This was a classic risk-free arbitrage for Graham and Buffett. Buffett personally bought 222 Rockwood shares, but didn't arbitrage, instead holding them because he noticed the real player behind the acquisition, Pritzker. Buffett realized Pritzker wasn't cashing out. As a major shareholder, he was smart. The cocoa beans Pritzker sold were just part of the inventory. Those who exchanged shares for cocoa beans gave up other cocoa bean ownership rights, transferring them to other shareholders for free. Buffett saw that Pritzker's buyback plan expanded his equity, while Graham helped him achieve his goal. As expected, Rockwood stock soared to $85 during the buyback. If Buffett had arbitraged, he'd have made $444. But instead, he earned about $13,000. At 26, Buffett and 32-year-old Pritzker learned valuable investment lessons from this deal. Graham and Buffett had similarities, but differed in personality. Graham was a pessimistic literature lover, with a messy personal life, treating economics as a livelihood. Buffett, an optimist, believed in the future of the U.S. and world economies. In 1956, as Graham aged and retired, 26-year-old Buffett, with $174,000, today's $2 million, began his independent investment career. Berkshire Hathaway, the company that would make him world famous, was acquired later, though Buffett considered it a failed acquisition. Berkshire, a 1888 founded family textile company, struggled in the 1950s-60s due to rising costs. Some shareholders sold stock below net asset value. Buffett planned to buy the company, liquidate it, and close it. A typical cigar butt investment. He quietly bought shares, but the actual controller, Seabury, detected Buffett's intent and made buyback offers above Buffett's purchase price to hike his acquisition cost. After talks, they orally agreed that Seabury would buy Buffett's shares at $11.50, letting Seabury keep control. However, the written agreement from Seabury unilaterally changed the price to $11.375, angering Buffett. He stopped selling and instead bought more shares to punish Seabury's dishonesty, just as he had shorted his teacher's stock. Seabury crossed Buffett's line fraud in business. In 1991, when Buffett invested in Salomon Brothers, a securities giant, a massive ticket forgery scandal by grassroots employees shook Wall Street, forcing the CEO to resign. Buffett took charge, faced the media, took responsibility, paid huge fines, and emphasized that credit is the biggest asset for individuals and companies, hard to rebuild once damaged. In the end, Buffett acquired a poorly performing textile factory, facing public criticism and unable to liquidate due to union issues. This was almost his only irrational investment. Yet it ironically became the world's greatest investment company. At the 2019 year-end Berkshire Hathaway media meeting, Buffett reviewed his investment career. For most of his life, he treated making money as a competitive game, excelling at it, and finding joy in it. Known for his frugality, sometimes exaggerated as stinginess by the media, he had no interest in charity. But with age, especially after his wife Susan's death, he began contemplating the meaning of money. In recent years, he's been active in charity. In 2018, he donated $3.6 billion to the Bill and Melinda Gates Foundation and 4 others, totaling $31 billion in donations. Buffett explained that he and his family feel fortunate, not guilty, and that 1% of their wealth suffices for their happiness, while the remaining 99% can greatly impact others' health and welfare. Thus, they chose to keep enough for their needs and donate the rest to society. He concluded that while we may not replicate Buffett's financial genius, his good reading habits, rigorous investment philosophy, honest business character, strong self-discipline, execution ability, and charitable heart are all worthy of our respect and learning.